Hey folks, David Frost, my strategic forecast. You're here for another episode of Common Sense Market Analysis. Today is Tuesday, July 18, 2017. Looking at a daily chart of the SPY or SPDR, which is the proxy for the S&P 500. And what can you say other than another light volume day today? Just over 40 million shares in the SPDR. A little more than yesterday, but not enough to make a dent in the market. We've basically tried to shimmy down earlier in the day, and then the market recovered mainly on light volume. That's the way it works. When you look at the, I'll even look at the hourly chart, it's pretty clear what happened. We took a dip. We gapped below the 245.40 level. We took a dip down early in the morning, and then the rest of the day, we climbed higher, finishing at the highs, not the all-time highs, but the highs of the day for the most part. And when you look at the daily chart, what we're doing here is beginning to, and it's only 2 days old, but, well, really 3 days since the high from Friday, but we're beginning to consolidate in this upper range around the 245.40. Now, if we continue to do that, the next move is going to be higher under normal conditions. However, this is options expiration week, and under normal circumstances, we're going to see the market trade in both directions during options expiration week. And let me just reiterate why for those of you who either don't know or forgot. So the way it works is the institutional traders have options desks, or the institutional investors with the big hedge funds, the large investment banks, they have options desks. And what happens is when you buy an option, there's somebody on the other side, for example. So it's the large institutional investors that are on the other side of that trade. Call them the market makers. And what happens is if you buy a call, they're selling a call. If you buy a put, they're selling a put. And basically their job this week is to make sure as much of those options, or as many of those options, expire worthless. And what they do is they have computer programs. And the computer programs figure out where the biggest bang for the buck is. So they look at where the largest open interest is and largest relative to where price is, both on individual stocks and on the SPDR. Okay, so they're going to take A, individual stocks, and B, the SPDR, or the S&P 500, in both directions to try and shake out the individual investor, or the unassuming investor, I should say. And they're going to try and shake them out, shake out the weak hands to make as many of those options expire worthless as they can. And especially when the volume is light as it is, it's very easy for them to push the market around in any direction they want. They have unlimited supply of funds, and they can take a stock and make it go up 3 points, make it go down 3 points. They can create a rumor. They can create anything they want. It happens over and over and over again, and it's very difficult for most people to wrap their head around that this actually goes on. But if you think about it, when you look at the amount of buyout or merger rumors that occur during options expiration week, and take example, in fact, I'll give you a good example today. Okay, here's CMG. All right, we look at CMG, and CMG took a dip today, or a dive, I should say, all the way down. Let's see, it closed yesterday. I'll just move this over a little bit. It closed yesterday, 392. Today's low was 362. Now, I haven't looked at the options chain. I don't know. It's not really that important. The point is that there was a story that came out about somebody got sick at one of the restaurants and they closed the restaurant. That's fine. That's very possible. They've had issues like that before. But if you think about it, and I'm not saying anybody did this, but I wouldn't be surprised, and this is way out in left field, I get that, but we don't have a lot to talk about with the market today, so I got to talk about something else. If you think about it, and if anybody's watched the show Billions, they did something very similar. The main character in Billions needed a stock to go down. He was short the stock. And what he did was he sent somebody in, not directly. He hired a guy who knew a guy who knew a guy. And they sent somebody in, or multiple people, to take something to actually make themselves sick and make it look like they got sick by having, it was, I think, at one of those like fruit drink places or healthy drink places. and it was a new IPO, and next scene shows a handful of people get sick as a result of going in to get one of their healthy drinks, and next scene shows the stock collapsed and he made a fortune. So I'm not saying that happened, but I wouldn't put it past anybody to do that. And CMG taking a dip like this during options expiration week, having somebody got sick in a restaurant and they close it down, it's just too convenient during options expiration week. Another case in point, you look at stocks that have constant buyout rumors. They always come out during options expiration week. Case in point is if you look back at a company called Citrix Systems. They've been theoretically bought out about 24 times, and they've never actually been bought out, but there's been rumors at least 24 times, and it always comes during options expiration week. So I'm a little weary during options expiration week of anything that happens, and I just take everything that happens with a grain of salt. I know this conversation comes out of left field. It's a little esoteric, but nevertheless, it is what it is. So looking back at the spider, if we consolidate in this upper range, then it's going to consolidate to make another move higher. Is that the likely scenario? It's not the likely scenario. However, it's a possible scenario. The flip side is, don't be surprised if you see some kind of a dip tomorrow in the markets. Tomorrow is also known as Whipsaw Wednesday, and on Whipsaw Wednesday, you generally see the market go in both directions and bigger than a bread box. So I won't be surprised to see the market take a dip down, potentially. Well, I'm not even going to give you a number because who knows, if it's going to take a dip down at all. But if it did, I wouldn't be surprised for it to go all the way down. I'll give you the number anyway, down around 243 and a quarter. That is a possibility, but I'm not forecasting that. I'm just saying if they turn the market around and needed to drive it down, I think that's where they would try and get it to. It's a logical area of support. You have a gap window over here, and you have some prior chart support over here with this red candle high. That comes in at 243.72, and this gap window comes in at 243.30. So anywhere in that zone down here is a possibility, but I'm not forecasting that. I'm just saying I won't be surprised to see that. Right now, in light volume, the path of least resistance is always higher. Right now, we've seen the market going higher, and until and unless we see a signal of a trend change, then it's just going to float sideways to higher and continue to grind higher. All right, let's move on to the IWM. The IWM was down 0.25% today, but we're not going to make anything out of it because, being down 36 cents isn't anything to shake a stick at, and we're above all the moving averages. We're in this range up here. All we're doing is going sideways, and the more we go sideways, the more the probabilities are that we're going to take another push higher. So I won't be surprised either direction the market goes from this point forward tomorrow. There's just no way to definitively say which way it's going to go tomorrow. We have to have a signal, and until we have a signal or a pattern to play off of, there's nothing you can do until the market gives you the goods. And right now it hasn't given us the goods the last few days. It's just floating around, and with that, we have to be good stewards with our money, and we have to be students of the market, and that's what I'm trying to do right here, right now. Just be a student of the market and wait for it to give me the signal of what its intentions are on the next move. When you look at the transports, we were down today 65 points, so that's something to hang our hat on. We have a divergence a little bit. The IWM and the transports were down. Obviously, the transport's down more, and the spider was slightly up. It was just north of the flat line. So with that, it's something, but again, we're in this upper range above all the moving averages. So technically, and I sound like a broken record on this, but it is what it is. Technically, there's nothing wrong with this market, the transports. As long as we're in this upper range, a down day here and there is not uncommon, not unexpected. In fact, it is common and normal market behavior. So we can't make anything out of a day down 65 points after we took a rally of 300 points from the time we busted out above this red candle here. So from here, it was, 94.67 and change, something like that. And then we made a high of 97.63. That's a tremendous rally. So with that, almost 300 points, you would expect some kind of a pullback, some backing and filling. So all in all, that's normal, common market behavior. Nothing wrong with this market whatsoever just yet. Although I will tell you that the earnings will pick up tomorrow, tonight after the bell, tomorrow morning, and then tomorrow after the bell. They're going to pick up considerably from certainly Monday, which there was virtually nothing. And then today there was some, and then tomorrow they'll really start to pick up. And from that point forward, they're going to come in buckets. So that can move the markets in one direction or the other. And I'm not saying which direction it is, just one direction or the other. I mean, if you look at Netflix, Netflix had a tremendous day. Just go over there real quick. NFLX. I can't talk and type at the same time. It's impossible. So, you know, Netflix up almost $22 today off of earnings last night. Just a tremendous run. We got right above this red candle high. It kept going, and we're at new highs. So there's nothing you can do with Netflix when you look at the monthly chart. I mean, this is just an extended move, and whether it goes to, you know, 200 or 190 or 195, nobody really knows until after the fact. The only way to play a stock like this is to wait for a reversal signal either on the weekly chart or you know, the daily chart or the weekly chart. And once you have a reversal signal, meaning a topping tail, a doji candle, a reversal candle, you have something to trade against. You know where you're wrong, and you can put a stop out above that high. But until that happens, you don't know how high this is going to go. I mean, I know people like to play extension moves and all that stuff, but the reality is nobody knows how high these stocks are going to go until after the fact. I've seen too many times traders try and short stocks into oblivion, and until they've capitulated out, losing, you know, more money than I care to even know about, you know, the stocks turn around after the fact, and you just never know when these stocks are going to turn around. And you just, in a case like Netflix, you just let it go until it can't go anymore. Let's go over to the gold market. Gold continues the upswing. You know, we talked about this for the last couple of days, and that as long as gold got above that red candle high over here, then the upside was going to be to 1245, which we have this line in here. We came up short today. 1244, what was the high? 1244 spot 10. So we came up 90 cents short of the 1245. And we'll probably get there. My guess is overnight or tomorrow, maybe over into the 50-period moving average. If we close above 1245, then I think 1260 is in the cards. So no change in gold. It's doing pretty much what we said. We had a bearish pattern. The bearish pattern at somewhat of lows on charts, recent lows anyway, has a tendency to fail. When a pattern fails, let me explain this. This is important information. So when a pattern fails, so you have a bearish pattern, okay, and it's generally going to release its energy to the downside. That's the way it works. But when the pattern fails, it takes the same energy that it would have otherwise released to the downside, okay, and it just releases it to the upside. So instead of this, you know, instead of this going down, okay, it's now releasing it to the upside. And in a lot of cases, in fact, more often than not, just from my experience, I see the move on a failed pattern typically a larger move than I would have otherwise been expecting out of this bearish wedge pattern. This bearish wedge pattern technically would have completed at roughly 1197, 1200, in that neighborhood, okay? That would be a nice measured move in that neighborhood. But we're already surpassed where this bearish wedge pattern would have gone on the downside. Now we're longer on the upside, and this is the energy being released on the upside tends to be more powerful in a failed pattern than would it have otherwise been on the downside in this case. Obviously, the reverse is true. If you have a bullish pattern and that fails, the same thing applies, just flipped upside down. Silver, pretty much the same chart, closing slightly above, or we are currently above the 20-period moving average in an upswing right now. This turned out to be a good tail low. Anybody that took that trade against that tail low, you know, just trail your stop. And the way you do that is on a daily chart. If you're a swing trade, in a swing trade, you're basically trailing it behind the prior day's low. So, for example, today, the stop would have been any close below yesterday's low. Tomorrow, the stop is any close below today's low. And that's the way you trail it up. And you let the market take you out. This way you don't have to make a decision. It takes a lot of the emotion away from the trade, having to make the decision. It's very difficult for all traders, and I'm not singling anybody out that's been in the business for a week, a month, or 30 years, it's all the same across the board. It's very difficult when we're trading with our own capital to make these decisions, because you always feel, A, like you're leaving money on the table if you're selling too early, or you want to hold on and then you end up taking a larger loss than you really should have. And that's why I always say your first loss is your best loss. But on the upside, you just trail the stop on a daily chart in a swing trade, with yesterday's low being the stop out on close. And then you let the market take you out. And that's the way it works. You never know how high these things could go. Look, silver can go all the way up to this red candle high, or it could stall out here and turn around. We just don't know. At the end of the day, this is still a bearish pattern, right? So you have this down move, all right? And this is still a wedge pattern, and this could still play out to the downside. I don't know that it will, but it certainly could. Or we can get above this red candle high, and we could rally all the way up to the 200-period moving average. Either scenario is possible. And today, you just don't know which one it is. I will tell you the odds will significantly increase that we're going to go up to the 200-period moving average if we close above this red candle high and the 50-period moving average. That would be the next major area of resistance along with this pivot high here. So that is certainly in the cards, but you have to get through one hurdle to get to the next. Until and unless you get through that hurdle, this is a bearish pattern. This won't be a bearish pattern so much anymore if we get above and close above this red candle high. So that's kind of the way it works. Well, not kind of. That is the way it works. Looking over at crude oil, what crude oil appears to be doing to me is beginning to consolidate right above, below the 50-period moving average. You see how we tested it 3 days in a row. Another couple of days like this, and it's poised to go higher. And the longer that it does, if it does consolidate in this range over here, so if we do this, right, and we just go put in a couple of more days like this, then certainly the odds favor the push higher to complete the ABC pattern or zigzag pattern. And that pattern is the one we've been discussing for quite a while here, which is the A leg, the B leg, and the C leg completing above the high of the A leg. And so that hasn't completed yet, but my take is that will complete, and we will get up to $48 a barrel, or potentially slightly higher, maybe even $48.50. We're going to run into a lot of resistance at this red candle high. This is a breakdown candle, and it's likely that oil wants to trade to that and challenge that red candle high, but it won't get through there in one shot. It's not going to be so easy. However, the longer we consolidate in this range, if we do, then the more likely we are to challenge that and potentially get through it. But right now, 48 is going to be the number until further notice, unless we consolidate like this for a week or so. Then I might change the tune. But another, couple of days like this, and I'm still not going to change the 48. 48 to 48.50 would be the upside objective from where we are now. Looking at the bond market, you can see where we are traded right up into the upsloping trend line, with the underneath or the underside of the upsloping trend line, right into the 20-period moving average and stop short. It's not a coincidence that we traded up into those two things, right? This upsloping trend line I've left on the chart for a reason. It's important. It's the market telling us, or the bond market in this case, telling us that these two pivots are important. This trend line is important. Once we broke down from it, we stayed below it, consolidated. Now we're challenging it. The question is, are we going to get above it and close above it, and that will take the trend line off the table? Or are we going to be rejected and trade back down? Only time will tell. Tomorrow is going to be a very important day for the bond market. And realize I'm not discussing this in the context of the bond market. I'm discussing it in context of the chart, and it could be any chart under the sun. They all act the same way. You know that I say that almost every night. But the reality is it's the chart pattern or the chart movements and the money flow that I'm discussing. I couldn't care less what the name was behind the chart, whether it's the bond market or whether it's Netflix or IBM. I don't really care. It's just the pattern and the money flow that's important. And right now, right into this trend line and the 20-period moving average is almost textbook. And we're either going to trade right above it and stay above it and this will have turned out to be a failed bearish pattern. And you know what happens? We just talked about that in the gold market, and this would be the same scenario. If this is a failed pattern, they're going to release the energy to the upside, and if that happens, there could be a lot more coming on the upside. But we need more evidence, we need more time, and time will tell. Tomorrow's going to be an extremely important day to see if we can close above this trend line. All right, here we are on the long and wrong dollar, and I did do some work on the dollar, and what I came up with and what it looks like to me that's possible, and I don't necessarily want to see this, but it's possible that 93.5, 93.60 is possible on the downside in the dollar. And if we get down to that level, that's an area where you should get a pretty hefty bounce out of that area, and that will be at the point in which you get maximum bearish tone coming from the financial community, the media, and all the pundits out there. Another, call it another penny lower on the dollar will bring out many, many bears saying that we're going to, the dollar's collapsing and all that stuff. You know that story. After the dollar's gone down as much as it is, that's when they come out and tell you the dollar's going to collapse, and that's usually at the point in which it finds some support. So that's the work I did on the dollar, long and wrong. It's painful, but it is what it is, and that's why this is a humbling business. You're not going to be right 100% of the time. It's impossible, and there it is. Target on the dollar on the downside, not a target meaning we're getting there, but if we should trade lower, that's where we're going to go, which is 93.50 to 93.60. And with that, I'm going to wrap it there tonight. I'm David Frost, my strategic forecast. Thanks for tuning in for another episode of Common Sense Market Analysis.